I was looking back there. I didn't understand what you were getting at on the variation in counting methods.
Okay.
Based on how you're organized.
Okay. So a sole proprietor.
Accrual accounting is accrual accounting, is that in?
But no, on a sole proprietor on the tax returns, they won't show any wage for the owner. And on a S corporation tax return, there would be a wage in there for the owner. So the same, we have a situation right now with a guy that makes $150,000 on a sole proprietor return. When we convert him to an S corp and pay him a $50,000 wage, it'll show a $100,000 bottom line. Now, the realtors that are punching in the data for the sale when that business gets sold, they're just going to take the tax return and punch it in. So you'd have two businesses, one's a sole proprietor, and you throw that into the database. If the business sold for $500,000 and it shows a $100,000 bottom line, well, there's a 5 multiple. But if it shows 150, it's a 3 multiple. Now let's take a whole bunch of transactions like that and throw them all together and call that our market data. You know, and that essentially is why market data is not, you know, as you get bigger companies, I'm about to go over size of companies, bigger the company gets, then you get GAAP financials. Then you start getting some quality. I mean, you know, what you're going to find out is that the majority of U.S. businesses are small enough that those kind of accounting variances exist there. You have to get, you know, you have to get to the size where somebody has a CFO on staff, they're doing GAAP financial statements, they're having an audit. Those transactions there's a lot of credible data out there for those. So the market value, there's 6 million U.S. employer businesses. There's 22 million businesses, but 6 million of them have employees. The rest of them are like holding companies for real estate and, you know, different things like that. There's 6 million companies that have employees. 18,000 of them are publicly traded. Okay, a publicly traded company would have a market value somewhere between, 5 million and 100 billion. So everybody's heard large cap, small cap, mid cap. I mean, we're all familiar with those. What that means is, like a small cap stock here, has a value in the marketplace of 100 million to 10 billion. So if you take all of their publicly traded stock that's floating around out there and you add that value up, what do you get? The market cap, the market capitalization. That's the market value. And so small cap is considered a small publicly traded company. A large cap is considered, I mean, I think Microsoft's in the large cap. I don't think they made the next step up. There's actually one level above that, mega cap or something like that. There's only 18,000 out of 6 million. Privately held middle market companies, they're not publicly traded, so, you know, how do you determine the value? If there's no, you know, it's easy to determine the value of a publicly traded company, just add up yesterday's trade value and all the stock they have outstanding, and there it is. That's a market value. Privately held companies aren't the same, but there are middle market companies between 5 million and about 10 billion in value. There's about 425,000 of those. That accounts for, I don't know, about 3 or 4%. What I call a Main Street business, privately held company that has a value of under 5 million. They have sales of under $10 million. There are 5.6 million of them. Okay, so 93% or 92% of all US companies with employees have less than 10 million in sales and are worth less than $5 million. 5.4 million, roughly 89% of all US companies that have employees have values under 1.5 million. They have less than 3 million in sales. So the majority of companies are less than 3 million in sales. If you have, I'm guessing 90% of the people in this room that own businesses have less than 3 million in sales, because 90% of all the businesses out there have less than 3 million in sales. And here's the thing about valuation. 90% of all the valuation procedures apply to the 425,000 companies that are bigger. To only 10%, you know, when I say, you know, what do I, one of the steps that I got to go through as a valuation analyst to do a USPAP valuation, I have to do a search for publicly traded comparable companies. So I'm doing, you know, Joe's Donut Shop, and I'm looking for a you know, what am I going to go get? Krispy Kreme and compare Joe's Donut Shop to Krispy Kreme. You know, there's steps in there that are fairly ridiculous. You know, like anything else. I mean, you buy a software package. How much of it do you know? How much of Word do you use? You use 10% of it. 90% of valuation procedures are for companies in excess of 5 million in value, excess of 10 million in revenues, and only 10% of those valuation procedures apply down here. I mean, so we just saw it in the income, asset, and market approach. There's not much to do on the market approach. I go through the motions, I pull the stuff, but it's really difficult to establish good market comparables. It's very, asset values, there's not really much really to look at, so it's income is what you've got to be focused on, and cash flow. There are a few exceptions. We did run into one company recently whose liquidation value was 2.4 million. Their cash flow value was 1.2 million, and because they could actually, shut the company down and sell the assets for more than what the cash, the cash flow wasn't proving the asset value. It was actually worse for them to continue in business because they were only generating $1.2 million of value staying in business. The problem was they were going for an SBA loan. The SBA doesn't back liquidations. They only back going concerns. So what value did they get? 1.2 million. The cash flow doesn't support a value higher than that. And the SBA won't back it unless there's cash flow. So there are situations where if you're in a business that does have substantial assets and your asset value is going to be higher, you may or may not have trouble in the SBA financing arena. You may have to go a different direction there when you sell your business in order to get the higher value. So to create value, you got to increase cash flow, decrease the perception of risk, which would increase, your multiple. Some of the things that increase, and I got to say that for 92% of the businesses, a lot of these things, there's not, for the small Main Street businesses, there's not a whole lot you can do. There's a lot more things you can do in the middle market to affect these values. On Main Street, I say, well, set earnings goals for your tax return. Eliminate discretion, eliminate some of the discretionary expenses. It may not, you may get those added back during evaluation, but the more add backs you have, the less credible your information is, and the larger the perception of risk is in acquiring a company. Set your owner's compensation at, if you have a valuation, you get a evaluation of what fair value of your compensation is. You can set it that way, and it's a lot cleaner. Adjust your self-charged rents, create unreimbursed expenses. I have people that are in partnerships where they have where one partner's running the company and one partner's silent, and the silent partner doesn't want to pay for a bunch of those discretionary expenses that the partner running the company can legitimately write off. The trip to Hawaii for the partnership meeting or whatever. I mean, and so what we do is we just bring those in as unreimbursed partnership expenses on the personal tax return of the managing partner. That way, the silent partner isn't paying for a bunch of perks and benefits. That way, the partnership return doesn't actually reflect a lot of those expenses that are discretionary, but the individual partner is still getting the benefit of the tax write-off. So, I know that to some degree it's just a little bit of smoke and mirrors in that sense, but a clean, you'll see as we move on here why a clean set of tax returns and financial statements can improve your sale proceeds. So limit your capital expenditures. I have a client that I did evaluation for, and I went out to his business and I stepped in the door, and I swear it was like walking through the 1950s. The place, hadn't been updated a lot, and it had that feel. I mean, I don't know the old gas pumps or, but I don't know how to describe it, but it just had this feel. But, as I'm talking to him and we're taking a tour of his business and he's explaining to me how he runs things, he says, well, necessity is the mother of all invention, and it just different thing. He doesn't spend a lot of money on his capital expenditures, upgrading his facility, doing a lot of these other things, unless it is going to improve his cash flow, and he knows in his business that he doesn't believe it will, and so why do it? And that's when I say that the 2% Club kind of intuitively understand business valuation. That's what I'm talking about. Decreasing risk would involve, here's a list of things. Establishing a management team. That's more of a middle market strategy. I don't find management teams to be extremely important on Main Street for Main Street businesses, because most of the time the guy that's buying the Main Street business is planning on running it. He's planning on being the management team, he or she. And so, and I've never met anybody that was buying a business that didn't think they could run it better than the guy that's running it now. And I think most business owners think that, well, the guy buying the business, I'm scared to death because he's going to wreck it. And, you know, but that's kind of how that works. So I don't know that a management team really adds a lot of value on Main Street, but it adds good, but a business that's a middle market business won't sell without a management team. The guys buying middle market don't want to manage it. And so there's no management team, no sale. Stable profits, positive earnings trend, customer diversification. Again, on Main Street, what's diversification? I mean, you know, I don't know. I think, again, you get that confident entrepreneur comes in, he's the guy, he's going to buy your business, he's going to run it, and he's confident he can hang on to that client. You know, customer diversification, not as important on Main Street, but very important in middle market. Covenants not to complete, employee incentive programs. Key employees, I think, are very important on Main Street. I think incentivizing key employees to stay through a sale. There's things like stay bonuses, there's non-qualified deferred compensation plans, which are basically profit-sharing plans that are discriminatory, where people can have vesting periods in their profit. And so if you can get if you have a key employee that you're worried about leaving if you sell the business, it's a good idea to look into some of those things. We'll talk more about that in the exit and succession area. But buy-sell agreement, document your systems and processes, and positive industry economic outlook. That one kind of, when I do valuations, that one kind of, the positive industry and economic outlook, I'm like, okay, so I gotta write this thing about where the country's going or what's going on. And there's all, yeah.
Yeah, I just had a question. Are you including like profit sharing plans into workers' compensation?
Probably not. Probably wouldn't do that one because that would be something that would go away if you sold. It would depend on whether it stuck around or not.
Well, it's obviously going to affect cash flow.
Right, but as we normalize owner's compensation, we would have to evaluate whether that, you know, and I've done, one of the hardest businesses to value is mortgage companies because the owner usually pays himself a salary, but he does a whole bunch of, originates a bunch of loans. Well, all the staff get paid on loan origination, you know, percentages. So how do you evaluate his compensation? You got to do the same way you do the staff, right? I guess what I'm saying is it would depend on the circumstances with the profit sharing program, whether I felt that it was necessary in order to replace the services that the owner provides.
So it sounds like at some point the owner of the company is going to make a decision, okay, in 5 years I'm going to want to sell this, so I'm going to change my strategies to enhance cash flow to make myself more attractive when it comes time to do that valuation or that sale. Because in the 5 years before that, my objective was to make my cash flow not the flow, but the net profit at the end of the year as low as possible, so I don't pay as much to own.
Absolutely. Strategies you use up to the point where you decide you're thinking about selling your business are going to be different than what you're going to use from there out. 100%. Okay? Back to the industry economic outlook, it's like, who can tell me what the stock market's going to do tomorrow? Does anybody know? Because that's what they're asking me to do, is tell you where it's going tomorrow. And I think that a lot of valuation analysts think that they're real smart and they're going to put all this stuff in their in their report to explain why everything's going to go this way. And I'm like, I don't even know how you can do that. I mean, you know, nobody can predict those sort of things. I mean, we have a general idea, you know, but I don't take it too seriously because it's very difficult to predict. They keep it pretty simple.